Hello and welcome to the National Real Estate Post. I'm your host, Frankie Ray, flying solo today. Before I get started, just to remind you guys that tomorrow, that's Thursday the 28th, 10 a.m. Pacific time, we're doing another webinar with Liberty Home Equity on their HECM purchase. That's a reverse mortgage purchase. Very interesting stuff here, man. I really hope you guys would jump into this webinar. You can click the banner you see right here over on your right. You might have to scroll down just a bit to click on it and register, or if on Facebook, there's a link up above. But listen, I think it's 10,000 people a day are turning 65 years old. It's just a great market to learn about and tap into. And I just want you guys to consider this. All of you guys, be it a real estate agent or a loan originator, you guys all have big databases of past clients. Guess what? They all have family in there that is more than likely eligible for these types of loans, that have spent their whole lives taking care of a home, right? But now they can let their home take care of them. And it's a wonderful government insured program. You're gonna wanna learn the ins and outs on this. Don't miss it. Great webinar. So again, this banner over on your right, or on Facebook, there's a link up above. We'll see you there for that one. Okay, so today I came across a couple of articles that I found pretty interesting. If you're probably aware, earlier this year there were certain groups that were really pressing the FHFA, Fannie and Freddie, and Mel Watt specifically, to look for alternate credit scoring models, alternate ways to devise a credit score for people that don't necessarily fit into the FICO mold, in an effort to really expand lending and to further help low to moderate income borrowers. So there's this push for a new scoring model that's not so FICO-ish, right? And of course, Fannie and Freddie hear this and they're open to the idea. In fact, it says here in a Market Watch article that I was reading yesterday, it says the Federal Housing Agency, Fannie and Freddie's regulator, put out a request for input from any interested parties that could be impacted if the two enterprises change how they gauge credit worthiness. Now here's this, a change that regulators admit might not be pressed into service for a few more years, and they're thinking at the soonest 2019, and the reason why that they're thinking it would take that long is simply because they've got bigger fish to fry right now over at Fannie and Freddie. So, but they are open to it, and they are looking at it, and they would like to possibly entertain an alternate credit scoring model for those that don't necessarily fit into the FICO mold. You know, again, this is looking to help low to moderate income borrowers. So then, in the same pass through the news as I'm reading things and looking for things to talk about on today's show, I come across a Housing Wire article. And this Housing Wire article is titled, let's see here, Will Alternate Credit Scores Really Help Close More Mortgages? Okay. And so basically, there's a couple of groups that got together and had sort of a brainstorming session on, you know, could alternate credit scores really help people? And if they do, how many people would really be helped by it? And it was really interesting. You've got the Progressive Policy Institute's in on this, and another company called Quantalytic. And so I just want to read this passage to you. Okay, again, with respect to alternative credit scoring and who it might help. Okay, so it says here, and I quote from the article, the problem with that is most of them have scores that are relatively low. If you look at the borrowers that might actually be potential candidates for a mortgage, the number is roughly around 2 million. Okay, so around 2 million people that might be candidates for this. And they got that number by eliminating borrowers with FICO scores below 620, and by eliminating people under 25 years old or people over 70 years old, and by eliminating existing homeowners. So when you do that, they say, so 2 million seems to be an agreed upon figure. But the problem with that is, it is also too high, these panelists conclude, right? That 2 million is just too high. So then another panelist, a guy named Tom Parent, he's the guy from Quantalytic, he agrees that the number of those who would be able to handle a mortgage is much lower than 2 million. Then they go on to quote, well, in any given year we found was that number is under, check this out, 50,000 people out of the 2 million that you would expand. You'd only get an additional 50,000 or so who would be likely to want a mortgage and be able to obtain one with other underwriting standards or a different credit scoring model. We happen to think that it's a good idea for people to have a path into the mainstream financial system with accurate, transparent scores, but what's not clear to us at all is that this would make much of a difference in the mortgage market. So there's a push for this alternate scoring, but based on these guys and this get-together of big brains, they figured it might only help 50,000 people a year. I ran this past Brian. He's not here today, but I ran what I was going to talk about today past him. His response was, well, hey, if we can help another 50,000 get in and it doesn't come at a cost to others, right? So in other words, people who aren't having any problems qualifying for mortgages under the current FICO standards, right? If it doesn't cost them anymore to allow this alternative credit scoring model to exist for these 50,000 other people per year, why not? I mean, I know I'd like it in my tool chest, right? If I'm originating right now or if I'm a real estate agent right now, I'd like that availability because I'll probably come across a few of those 50,000 people and I'd like to be able to get them in. But so I guess what I'm asking you guys, this is what's your thoughts on this. Again, the soonest we could probably see anything on this might be 2019 or maybe even later, according to Mel Watt. But is it something that's needed? Is it something that would help you? Is 50,000 enough people to go through all the trouble of getting this done for, right? Is that something we should really be spending time and energy and money on if it's only 50,000 people a year? So with that, leave us your comments down below. Do us a favor, forward, share, and subscribe. It's going to be kind of a light week going into the new year. We know that. We know you guys are probably taking some time off, well-deserved anyway as well. So with that, have a great day. Don't miss that webinar. It's a really, really great webinar. You're going to get a whole lot out of it. It's going to open up a whole new market for you. Again, their banner is over on the left-hand side. You might have to scroll down, Liberty Home Equity Services, and then there's a link up above on Facebook. With that, we'll catch you guys tomorrow here at the National Real Estate Post.
Well, Reverend, please come quick, 'cause I got something to admit. I met a man out in the sticks, a good old miss. He drove a Series 10 Cadillac and wore a cigar on his lip. Don't you know the devil wears a suit and tie? Saw him driving down the 61 in early July, white as the cotton field and sharp as a knife. I heard him howling as he passed me by.